So while an S Corp does have a potential to give you a big savings in taxes, it also can be a very costly mistake.
What are the differences between an LLC versus an S Corp? We first need to address that these are two different types of terms. An LLC is a type of business entity. LLCs are a type of business entity that you can form, and S Corp is a taxation status that you can choose to be taxed as once you have formed an LLC. Two very common business types are sole proprietorships and LLCs. Single member LLCs by default are automatically taxed the same way as a sole proprietorship. And to understand what an S Corp is, we first need to go over the differences between sole proprietorships and LLCs, because LLCs are automatically taxed the same way as a sole proprietorship.
Having a sole proprietorship means that you and your business are one and the same. There's no separate entity formed, so therefore all assets, including money, your house, and your car, which looks like a turtle, all belong to you and your business. There is no separation here. Because you and your business are one and the same, when money comes into your business and you make a sale, then that money automatically passes on through to you. When it comes to paying taxes, all of that money passes on through to your personal tax return. That income is going to be claimed on your personal tax return. It's then going to be subject to 3 different types of income taxes: federal and state income taxes, as well as what is known as self-employment tax, which equates to 15.3% and covers Medicare and Social Security. This 15.3% applies to your total. Let's compare this type of business to a different type called an LLC, a limited liability company. Forming an LLC separates the business and the business owner. They are no longer one and the same and are two completely separate entities, and each has their own assets. So that money, your house, and your weird turtle car are completely separated and protected from the business's liabilities. Now, in terms of taxation, you have 2 different options of how to be taxed. Option number 1 is the default. When money goes into your business, in order to pay yourself, you simply need to do what is called an owner's draw, transferring money over to your personal bank account from your business bank account. You can also write yourself a check from your business account. This is the default method, and you're going to be taxed again as a pass-through entity. Your LLC is going to be disregarded by the IRS, and that income is going to go onto your personal tax return, and you're going to pay federal, state income taxes, and self-employment tax. Now, option number 2 requires you to file additional paperwork with the IRS and elect S Corp taxation status. You and your business are still separated, you're still an LLC, but you're going to be required to hire yourself as an employee. This means that in order to pay yourself, you're going to have to issue payroll to yourself. And that comes along with taking out payroll taxes. Payroll taxes are going to include federal and state income tax, as well as FICA, which includes things like Social Security and Medicare taxes. Now, there's a potential for tax savings here because you're required to pay yourself a reasonable salary, but any profits that are left can be transferred over to yourself in the form of distribution. While distributions are taxable income, they are not subject to that 15.3% self-employment tax. This means that you can save yourself that 15.3%, and it can equal a big tax savings. But first, you need to make sure that you are able to hire yourself as an employee, which means you're going to have a payroll system in place. You're going to have to be compliant with your state employment requirements, such as getting workers' comp insurance, and you have to pay yourself a regular, reasonable salary.
So now that we understand that forming an LLC and then filing that additional paperwork with the IRS to elect S Corp taxation status can potentially result in saving 15.3%. So now that we understand that forming an LLC and filing that additional paperwork to elect S Corp taxation status with the IRS can result in a large tax savings. How do we know if it is right for your business? There are some very specific costs that you need to understand before you make this decision to make sure that it is a financially sound decision for your business.
So while an S Corp does have a potential to give you a big savings in taxes, it also can be a very costly mistake. I want to break it down for you so you understand and can make the best choice for you and your business. If you file the additional paperwork with the IRS to elect S Corp taxation status, then you're going to be required to hire yourself as an employee of your own company. This means several different additional expenses, such as payroll costs for either hiring a bookkeeper or getting a payroll software, staying compliant with your state's employment laws, which oftentimes includes getting workers' comp insurance, which can be an additional monthly expense. Now, once you've hired yourself as an employee, then you are going to break down your income into two different ways of receiving that income. This is going to be paying yourself a reasonable salary and giving yourself the remainder as a distribution. Now, you're required to give yourself a reasonable salary, so let's just go ahead and put 50% into your salary and 50% into a distribution. From that salary, you're going to be required to pay payroll taxes. This is going to be that Social Security, Medicare, and other expenses. Your distribution is not subject to payroll taxes, and it's not subject to self-employment tax, which is the big tax savings here. You're going to save 15.3% in taxes on what you receive as a distribution. Now, the next expense here that is never covered in these other videos is the QBI deduction. This is the qualified business income deduction, and it allows owners of pass-through businesses to claim a tax deduction worth up to 20% of their qualified business income. Now, you can only claim this on the amount that you receive as a distribution, not on the salary portion, which means only 50% of your income here is going to receive that QBI deduction. Now, if you're a sole proprietor or if you are an LLC that did not file S Corp taxation status with the IRS, you are defaulted to a pass-through taxation status. And if you're an LLC, you're what's known as a disregarded entity. You equal your business in terms of your business income taxes. All of the income that comes into your business is yours, and you will pay yourself using an owner's draw, a simple transfer from your business checking to your personal checking or writing yourself a check. Now, this then means that all of your self-employed income is going to be subject to federal and state income taxes, and all of that income is going to be subject to self-employment tax, which is 15.3%. And that tax is going to be applied to 100% of your net income. Now, 100% of this self-employed income qualifies for that QBI deduction. So you are going to see a difference here between the amount of your income that qualifies for the QBI. So filing to have your business taxed as an S Corp means a lot of different changes for your business. So before you do this big change for your business, there are some very specific things that I want to make sure that you understand. Yes, this can equal big savings, but it also can equal way too many expenses that you are not ready for. So first, before you file, check and make sure, can you handle the extra expenses? Payroll, running payroll, all the expenses associated with that, like workers' comp and staying compliant with your state. Can you pay yourself a regular, reasonable salary? Is your business income stable and steady and large enough to pay yourself that regular salary? Next, what are the things you're going to need to do to stay compliant within your state and your state labor laws? Make sure that you fully understand those obligations. Next, does the change in the QBI deduction outweigh the tax savings from self-employment tax? The only way to know this for sure is going to be to consult a tax professional. Getting information from trusted sources on TikTok and YouTube can help point you in the right direction of ideas and useful information. But if you are thinking about switching to an S Corp, make sure you consult with a tax pro.